And of course, we are covering an update on 2011 California tax law. And the thing about 2011, as I said when I did the federal update, is that it wasn't terribly exciting as a year for tax change legislation, either at the federal level or at the California level. Most of the big things that changed in 2010. And so 2011 is merely a continuation of that. So what I've done for today's class is I've talked about what did change in 2010 and some of the other more recent changes that have occurred in the last, say, 4 years. And I've also talked about some of the features that California has either added to its websites or added to its processing systems, or various just things that are going on at the California level that California has announced in press releases and so forth. So clearly it believes that that information is important, and therefore I've included all of that, or as much of it as I could, in the manual. Now this is a 1-hour class and a 40-page manual, so I'm not going to be reading from it. I'll really be skimming through it and highlighting the things that I feel are the most relevant. And after the class is over, if you feel you want to know more about a particular topic, the manual offers quite a bit of detail on each topic that I do cover. And you can go read up on that if it's of interest to you, and then you can also visit any other website links that I might have inserted in the manual to help you learn more again. So beginning with course objectives, by the end of this class you should be familiar with recent changes with California tax laws affecting the preparation of 2011 returns, also some highlighted conformity issues between federal and California tax law, and a review of certain adjustments to be used on Schedule CA in figuring your California income. Now the big deal about California, or preparing a California tax return, is really you start with the federal return and then you move over to California and you adjust the California return to take into account differences between California law and federal law. And the differences are broad and numerous, and we're not going to attempt to cover those in this class. Of course, we have a variety of other courses offered through Pacific Northwest Tax School that cover California law, in particular a course called California Adjustments, which really goes into a lot more detail on many of the adjustment items that we may just mention today. So moving on, let's start with estimated tax due dates. And due to the fact that April 15, 2012 falls on a Sunday, and Federal Emancipation Day holiday follows on Monday, April 16th, the final day of tax season is going to be Tuesday, April 17th, 2012. And for that reason, that is also the final day for making estimated tax payments to California and having them considered to be finally. All in all, the filing season will end on April 17th, 2012, but California gives filers an automatic 6-month extension to file tax returns that will take you all the way out to October 15, 2012. So after October 15, 2012, your California tax return will be deemed to be late, and also you have only until April 17th to pay your California tax. So although the extension is automatic, there is no extension of time to pay. So any tax that you owe California, be it estimated tax or the income tax liability owed with your California return, both those amounts will be due on April 17th, 2012. Also, as a reminder, California no longer mails the income tax booklets out. If you want any of that information, you have to go to the website and print it off yourself. And here is the new California form for 2011, California Form 540. Not much has changed on it other than you will see that the exemption amounts have gone up. They were $99 in 2010, and they've gone up to $102 for 2011. And the exemption deduction that was only $99 for 2010 has jumped up to $315 for 2011. On page 2 of the form, the most significant change is that the child and dependent care credit is no longer refundable. And because it's no longer refundable, it is moved up to the non-refundable credits portion of the form. So you can see that line 40 is now used to report non-refundable child and dependent care expenses. And that particular credit used to be down here in the payment section. And then on side 3 of the form, contributions used to all fit in a single column. Now they're divided up into 2 columns, and they've essentially added space for some additional qualifying charities. So let's take a look at the 2011 filing requirements. And of course, California has a 4-step process that it uses to determine whether or not you are required to file a California return. Step 1 is to look at your gross income. And you look at your gross income according to the California gross income chart. You look at your filing status in this first column on the left, and then you look at the number of dependents you are claiming under the gross income portion of the chart. If your income is more than the amount shown on the gross income chart for your filing status and number of dependents, then you are required to file a return. If you don't meet the filing requirement based on your income, filing status, and number of dependents under gross income, then you move over to California adjusted gross income and look at your filing status, age, and number of dependents under this chart. And if you do not meet the filing requirement under the second part of the chart, then you are not required to file a return unless Step 3 or Step 4 apply to you. Now, of course, because the exemption deductions and the standard deduction amounts have gone up for 2011, all of these filing requirement amounts are an increase over what was on the filing requirements for 2010. Step number 3 says if you don't meet the filing requirements because your income is less than the amount shown for your filing status, age, and number of dependents under either the gross income chart or the adjusted gross income chart, then it says, is your income less than these amounts? See requirements for children who have investment income and other situations in which you must file on the next page of the instructions. And then step number 4, are you married or RDP filing separately with separate property income? If no, you do not have a filing requirement. If yes, prepare a return. And if you owe tax, you have a filing requirement. So here are the other situations when you must file that are mentioned in step number 3. Firstly, if you have a tax liability for 2011 or owe any of the following taxes for 2011, you must file Form 540. And then we have tax on a lump sum distribution, tax on a qualified retirement plan, including an IRA or an Archer medical savings account, tax for children under age 19 or under age 24 who have investment income greater than $1,900, the alternative minimum tax, recapture taxes, deferred tax on certain installment obligations, and tax on an accumulation distribution from a trust. Also, just as a reminder that the requirements for children who have investment income state that California law is the same as federal law when it comes to reporting the investment income of your children who are under age 18 or who are under age 24 and full-time students. And if you're going to report the child's income on the federal return, it does not necessarily follow that you must do the same on California or vice versa. So California specifically states that you can elect to report your child's income on the California return, and you can also elect to report it on the federal return if you meet the conditions for reporting it. But you can also report it on the federal and not report it on California, or you could not report it on the federal and then yes, report it on California. If you decide to report the income on your California tax return, you need to attach the appropriate forms. So if you are reporting the investment income of your child who is either under age 19 or under age 24 and a full-time student, and that child received more than $1,900 of investment income for the year, you complete and attach FTB 3800 to figure the tax on a separate Form 540 for your child if the child is filing their own tax return. But if you elect to report that child's income on your return, then you would attach Form 3803 to your return. And there are pluses and minuses to reporting the income of a child on your return. Pluses are that the child does not need to file their own tax return, and that can be arduous and labor intensive. But a negative is it could throw the parent into a higher bracket, and it could take away certain tax benefits that the parent might normally be able to qualify for. And moving on to the next part of the tax return, we're looking at filing status. And just as a general rule, you use the same filing status on your California return that you use on your federal return. So whatever filing status you choose for the federal, you're generally supposed to use the same filing status for California. And of course, there are 2 major exceptions. And here they are. If you file a joint return for federal purposes, you may file separately for California if either spouse was an active member of the United States Armed Forces or auxiliary military branch during 2011, or a non-resident for the entire year and had no income from California sources during 2011. But there is a caution here. If the spouse earning the California income is domiciled in a community property state, community income will be split equally between the spouses. And both spouses will have California source income, and they will not qualify for that non-resident exception. So that's the one where you have a situation either one spouse or both spouses are in the military, or you have at least one spouse being a full-year non-resident. But the second situation is when you're dealing with California domestic partners or California same-sex marriage. And clearly, since the federal return does not recognize same-sex marriage, on the federal return, when you have RDP couples or same-sex married couples, you're going to have a filing status that is usually going to be single or head of household. And California is going to say, well, you're probably going to be either RDP filing jointly or RDP filing separately. And on California, you're going to be married filing separately or RDP filing separately or RDP filing joint in most situations, unless it happens to be the case that you meet the qualifications for head of household. But what California wants RDPs to be aware of is that same-sex marriages and registered domestic partnerships established in states outside of California are recognized by California. So you're going to have to continue to apply the RDP rules for those individuals in California if they were residents of California. And a big thing that happened in 2010 was that the IRS recognized community income for RDPs. And this is a relatively new procedure, and so IRS is still working on releasing information. And in 2011, it did update its website to include a question and answer screen, and I have a link to it here, where individuals who are subject to their state's community property laws can go to see questions and answers and see if there are situations that impact them because they are registered domestic partners. Now, registered domestic partnerships are currently recognized in a number of states, but we're only concerned about community property law in those states that have community property law. So currently, states that have community property law and also have registered domestic partnership laws in place include California, Nevada, and Washington. So if you are in a registered domestic partnership in California, community property law applies to you. And you should be careful to apply community property law when you file your return. And the big part about community property law is in particular when it comes to wage income. The separate wage income of each partner is considered to be community income, and therefore each partner will share equally in the income of the other as well as in the division of federal withholdings and state withholdings of the other. And of course, more information about that is also available in Publication 555. Moving on to the exemption credit deduction, and as I pointed out at the start of the class, California has upped the exemption deduction or the exemption credits for personal, blind, and senior, and they've gone from being $99 to $102. But just as a reminder, as your income passes a particular threshold amount based on your filing status, there will be a phase out of your credit. And the phase out works as follows. If your filing status is single and your federal adjusted gross income exceeds $166,565, then your exemption credit is reduced by $6 for each $2,500 that your income exceeds this threshold amount. And of course, your filing status will dictate what that threshold amount is where the phase out begins. Please note that this particular phase out affects only the individual or spousal exemption credits as well as the age 65 or older or blind credit, and that it does not apply to the dependency exemption credits, so no phase out applies to dependents exemption credits. And for 2011, that exemption credit for dependents is back up again. It's at $315 for 2011. And remember, back in 2008, we had a much higher exemption credit in place. In fact, in 2008, that exemption credit was $309. But then in 2009, it dropped to $98. And then for 2010, it was $99. So that would have been a big impact to families with children who would have seen a significant difference in the amount of tax benefit allocated to their children in those two particular years. But the credit has gone up again. And that is largely, of course, due to budget crises in California and just extreme measures it had to take to help close the budget shortfalls that it was experiencing. Moving on now, we're going to be looking at Form 540, line 14 and 16. These are the two lines of the form where you claim adjustments to income, or California adjustments to income, in the form of subtractions and additions. And just as a reminder, that California law and federal law are generally tied, but California essentially has periods of time where it convenes in the legislature and makes definitive decisions on how California accepts or adopts or rejects and does not adopt particular provisions of federal tax law. And currently, California has made adjustments or provisions for federal law as of January 1, 2010. But what that means is that California may not have adopted or made provisions for changes to federal tax law that took place after that date. And so as the federal government passes law, California falls more and more out of conformity until its legislature meets again and decides on what the new conformity issues are, or how California will conform to those new laws as they are adopted. But it's always late and it's always after the fact. And because California either adopts or rejects federal tax law, sometimes months or years after federal tax laws have passed, there is usually a period of time after a federal law passes that California is not conforming, and that at some later point California will make a decision to either permanently not conform, or it will decide that it will conform at some later point. And here's, of course, Schedule CA. This is the form that is used to explain or to factor for differences between federal law and California law on the return. It's a two-page form. Page 1 has to do with differences between California income and federal income, and California adjustments to income and federal adjustments to income. And then on Part 2, on side 2 of the form, then we look into adjustments to federal itemized deductions. And that is, if the federal allowed a certain amount of itemized deduction, is California going to allow the same amount of itemized deduction or a different amount? So let's take a look at some of those differences. With California Schedule CA, line 7 is the first line that we're going to look at. And for 2011, there is a difference between California law and federal law when it comes to employer-provided adoption benefits exclusion. Federal law increased the maximum amount of employer-provided adoption expenses exclusion per child up to $13,360 for 2011. California does not conform to the federal increase, and its exclusion is limited to $12,360. That's a $1,000 difference. So if you have an employer who paid for your adoption expenses for you, that employer is allowed to exclude up to $13,360 of adoption assistance provided to an employee. That means it's allowed to pay for those expenses, and it's not income to the employee. But if those expenses exceeded $12,360, then California will want you to enter an adjustment on the California return in the form of an addition, and the maximum amount of the addition is $1,000. Also, in 2010, a new law came into being in California, and this is just a reminder about that. It refers to the exclusion for in-home supportive services, or IHSS supplementary payments. And California laws allows an exclusion from gross income for IHSS supplementary payments received by providers. And if you are such a provider, then you would enter an adjustment on line 7 in column B and claim a subtraction for those tax-free assistance payments. California excludes from taxes the health care coverage for children, adult children up to the age of 27. Well, when the federal government passed new legislation that allowed parents to include health insurance for their adult children under their own plans, California was a little bit sluggish in adopting to that rule. And so what we had at the end of 2010 was a difference between California law and federal law with regards to this provision. The federal government said that if you are an employee on the job, you could go to your employer and ask your employer to include your children on your employee plan. and that would be a tax-free benefit to you, and that your employer was required to include that, or the employer's and health insurance company was required to allow those children to be included. And if this was a tax-free benefit that was allowed for you, that was great. You didn't need to include it on your federal return. Well, at the end of 2010, California said, well, we're only going to allow you to claim a deduction for health insurance premiums paid for your children, your adult children, if they were your dependents. And if those children paid more than 1/2 of his or her own support, then you would have an addition to income on California. Well, towards the end of the 2011 filing season, specifically on April 7, 2011, California adopted the federal provision in full. So what that meant was, if you'd gone through the California tax season filing California returns, you may have included the value or cost of health insurance premiums paid for non-dependent adult children as income on the California return in the form of an addition. You may also have had an addition on the California return if you claimed a deduction for self-employed health insurance, for example, on the tax return of the parent, or you claimed an itemized deduction for the cost of health insurance premiums paid for non-dependent adult children. If any of those things happened, then you will want to go back today and amend the 2010 tax return to take off that taxable benefit and reduce the California taxable income. So it was a late change late in the season, and I don't know that it was a huge problem, but there are probably a number of people that will want to amend as a result of it. Some of the bigger differences between California and the federal government happen when it comes to business tax provisions, in particular differences for depreciation. And although there's nothing new in terms of differences between depreciation for California and federal for 2011 over, say, what was in place for 2010, I still feel it's important to cover these. Now, depreciation is, of course, a very specific topic of tax law. And if you don't understand depreciation really well, talking about how California depreciation differs from federal depreciation may seem somewhat nonsensical to you. And if you don't understand depreciation well enough to understand what I'm talking about here, then I would recommend that you take our course called Depreciation Made Easy, where we spend about 5 hours talking about how to compute depreciation and all the rules relating to depreciation. Now, assuming that you understand the rules for depreciation, as we get into these differences between California and federal, they should make sense. And again, if they don't make sense, then the place to go is more education. So California law is, of course, based on federal law. And this means that California law and federal law are generally, but not always, the same. And you figure differences between federal and California law for depreciation and amortization on specific schedules that California provides. And then whatever difference you calculate on those schedules is going to be an addition or subtraction on your California return. And specifically, those depreciation differences affect profits reported on Schedule C, E, and F, as well as from flow-through entities like partnerships and S corporations. So if you have business income coming from C, E, F, or from a partnership or S corporation that's flowing through to you on a K-1, the odds are that you probably will be reporting a difference in depreciation. So California law conforms to federal law for a very small number of depreciation provisions. California generally conforms to the federal 2003 increase for the limitation on luxury automobile depreciation. However, California does not conform to Internal Revenue Code Section 168. Essentially, the provisions of IRC 168 have to do with bonus depreciation. California does not allow bonus depreciation. In addition, sport utility vehicles and minivans that are built on a truck chassis are included in the definition of trucks and vans when applying the 6,000-pound gross weight limit. However, California does not conform to the federal increase to first-year depreciation for qualified vehicles placed in service in 2011. So here are a bunch of other areas of depreciation where California does not conform to the federal. And as I said, these are not new, but they're certainly things that tax practitioners should be aware of, because if you do a business tax return, you're probably going to have to be making adjustments in your software entries to account for these differences. Again, firstly, and beginning with 50% bonus depreciation, and actually we had 75 and even 100% bonus depreciation in for 2011. California does not allow bonus depreciation, so if you claimed bonus depreciation, you will have an addition on your California return for the year you claim bonus depreciation on the federal return. And for every year after the year where you claim bonus depreciation on the federal, California may and likely will have the equivalent of a subtraction, because in the early year, federal is giving you more and California is giving you less. And over time, federal will give you less and California will give you more. Also, the Section 179 deduction thresholds are increased to $500,000 and $2 million for the limit amounts at the federal level for tax years 2010 and 2011. But California, ever since 2008, has imposed a maximum Section 179 deduction of $25,000. So that's the maximum amount you are allowed to claim as a Section 179 deduction in California. What that means is if you claimed a Section 179 deduction on the federal return that is greater than $25,000, you will have an addition on your California return for the year that the asset is placed in service, and for every year after that, your California depreciation could be larger than the federal on that particular asset. Also, for taxable years beginning on or after January 1, 2005, the federal changes regarding treatment of distribution costs and treatment of participations and residuals for purposes of computing depreciation under the income forecast method differs. For tax years prior to 1987, California did not recognize the acres recovery system, so there can be differences carrying forward through time for that. The additional first-year depreciation on certain qualified property placed in service after October 3, 2008, and the election to claim additional research and maximum tax credits in lieu of claiming the bonus depreciation is also not allowed for. The accelerated recovery period for depreciation of smart meters and smart grid systems, the decreased holding period for built-in gains, the federal law increase of first-year depreciation by $8,000 for qualified vehicles placed in service in 2011. So what this particular rule is about is that at the federal level, if you own a passenger car that weighs less than 6,000 pounds, your maximum allowable depreciation deduction in the first year is increased by $8,000 if you take bonus depreciation on the vehicle. California not only does not allow bonus depreciation, it also does not allow for that $8,000 first year increase. In 2010 only, federal law allowed an increase in startup expenses. The startup expense threshold had been limited to $5,000, and for 2010 it was increased to $10,000. But California did not accept or adopt that particular increase. So if in 2010 you claimed startup expenses on your tax return that exceeded $5,000, California will probably have amortization taking effect in 2011 that is greater than the amortization you are claiming on the federal return for startup expenses. Federal removal of cellular phones and similar telecommunications equipment. The IRS has said that cell phones are no longer listed property. California does not conform and says that cell phones still are listed property. So how do you report differences between California and federal depreciation? Well, you use California Form 3885A to report these differences in depreciation. And if California depreciation is higher than federal depreciation, enter a subtraction in column B of Schedule CA. And if California depreciation is less than federal depreciation, enter an addition. And here is the California depreciation difference, Form 3885, and it's laid out similarly to Form 4562 for federal depreciation, but of course it is allocating the California differences or the California limits. And the first password of our class today is Shasta. Please jot this password down. It is spelled S-H-A-S-T-A, and then use this password when you take the password test at the completion of today's class. So moving on to some of the other items, the surviving spouse on Schedule CA line 13 for capital gain or loss. This is just a reminder. California allows a surviving spouse to exclude from gross income up to $500,000 of gain from the sale or exchange of a principal residence owned jointly with a deceased spouse if the sale or exchange occurs within 2 years of the date of death. Now on line 21, the big thing to focus on is NOL deductions. And again, because of the budget issues in California, California suspended a lot of different things, including NOL deductions. For taxable years beginning in 2010 and 2011, California has suspended the net operating deduction or net operating loss carryover deduction. Taxpayers may continue to compute and carry over an NOL during the suspension period. However, taxpayers with modified adjusted gross income of less than $300,000 or with disaster loss carryovers are not affected by the NOL suspension rules. For taxable years beginning in 2008 and 2009, taxpayers with net business income of less than $500,000 or with disaster loss carryovers were not affected by the suspension rules. Now, because of these particular provisions, anyone who is not allowed to claim an NOL because their AGI is above those threshold amounts, their ability to carry forward has been extended by up to 4 years, depending on the year that the loss is claimed. So there's about 2 pages here of information on NOL provisions. We then move on to the mortgage relief on the sale or disposition of a principal residence. And again, this is not a new rule. It's been around for a while. Really, 2007 was the first year that the IRS had a specific policy in place that allowed distressed homeowners who had to sell their home and basically had debts canceled by their banks because the amount that the house sold for was less than the amount borrowed on the house, that those particular situations where there was canceled or forgiven debt, that debt could be excluded from income. And California follows those provisions a certain amount. However, there are differences. At the federal level, the maximum amount of qualified indebtedness that you could exclude is $2 million. But California allows for much lower limits. The maximum value or cost of the house that is sold is $800,000, and the maximum amount of debt relief is $500,000 for tax years 2009 through 2012. And for 2007 and 2008, qualified principal residence indebtedness is limited to $800,000, and the amount of debt that a filer can be relieved of is $250,000. And those numbers are, of course, half that if your filing status is married or RDP filing separately. So what this means is if you were allowed to exclude canceled debt from the discharge of indebtedness on the sale of your principal residence at the federal level, and if the selling price of the property was high enough that the amount of indebtedness discharged is over $800,000, there's going to be some limits applied to you. And we talk about that all the way through here until we get down to this part at the bottom of page 18. California does have a provision in place that it is using to try and help distressed homeowners, and it has to do with short sales. And California says that a short sale occurs when a distressed homeowner sells his or her home for less than the loan balance. Sometimes during short sale transactions, there may not be enough funds in escrow accounts to pay a California recorded state tax lien in full. If this happens, FTB may be able to assist the taxpayer with a partial release of lien. A partial release of lien releases a specific piece of property from a recorded state tax lien. However, it does not release the lien in its entirety. The lien remains in effect against the taxpayer and continues to encumber other property that the taxpayer owns or acquires in the future. So essentially what is going on here is California wants to be able to facilitate the sale of this house, and it doesn't want the fact that there is a tax lien on the house to inhibit that selling process. So it is prepared to remove the lien off of the house, but not off of the taxpayer that owes the tax. To expedite a partial release of lien request due to a short sale, the following documents are required by FTB. A letter of explanation detailing the request, estimated closing statement, current preliminary title report that includes the legal description of the property, a current appraisal, documentation to substantiate all lien payoffs through escrow, a lender's short sale approval, and additional documents that may be necessary. The above documents should be sent by the escrow or title representative handling the short sale transaction to the address shown here. So the purpose of all of this is that the FTB wants to make sure that there's no funny business going on here. So during the evaluation process, FTB will review the reason and substantiation for the request, verify that the property is being sold at or near the fair market value, determine that industry standard fees and commissions are being charged, and confirm that only senior lien holders and or judgment creditors are paid. And although FTB works to process a partial release of lien requests as quickly as possible, you should allow up to 21 days for that to occur. Next thing we've got is a real estate tax deduction. California law conforms to federal law regarding the real estate tax deductions. So really there's no newness to the real estate tax deduction for 2011, nor is there a difference between how California and federal allow for real estate tax deductions. However, California apparently has observed that there are a number of filers who are claiming real estate tax deductions that they are not entitled to. So this is just a reminder of the rules and the fact that California is implementing a new filing requirement or a new reporting requirement beginning with 2012 tax returns. So what California has to say is that if you itemize deductions, you can claim deductions for real estate tax on Schedule A of your federal individual return. And you are allowed to deduct only the amount of real estate tax paid during the year that is based on the assessed value of your property. You cannot deduct amounts shown on your property tax bill that are not computed based on the assessed value of your property, including special assessments, special taxes, Mello-Roos fees, or charges regardless of their purpose, with limited exceptions. And for more information about allowable real estate tax deduction, go to ftbca.gov and search for real estate tax, or go to the instructions for Schedule A. So what's new? Well, beginning with 2012, the California return will add reporting requirements related to real estate tax deductions taken on your return. And this will include the property parcel number, deductible and non-deductible amounts. You will need to retain a copy of your property tax bills to complete this information. So beginning with 2012, our tax clients are going to need to be bringing their property tax bills into us as a part of preparing their tax returns. And this is probably not something most customers are in the habit of. Now, I know my clients frequently bring in their property tax bills because they say important tax information on them. But I don't typically look at the property tax bill as the source of my deduction, because the property tax bill only shows that tax was assessed and the amount of tax assessed. It doesn't tell me that it was paid or the date that it was paid. So when I go for property tax deductions, I typically go to the 1098 document to see if the mortgage company reported a payment out of escrow, or I'll call the county directly and see how much was paid on what date, or if my client has their canceled checks showing that taxes were paid on a specific date, I'll work off of that as well. So for California, not only are you going to have to see those specific dates and proof of payment, but you're also going to have to be concerned with seeing the bill itself to make sure that any deduction claimed for property taxes is not greater than the allowable deduction for property taxes. And of course, looking at Schedule CA line 41, other adjustments to itemized deductions. I'm not going to read these to you. However, California has a number of adjustment items that may cause your itemized deductions to go up or down for the California return. And this is a list of those items that could cause differences. California Schedule CA line 43, reduction in itemized deductions. For tax years 2010 through 2012, the federal limitation on itemized deductions has been repealed, and this means at the federal level there is no phase-out of itemized deductions. But California has no similar repeal of its provision, and the phase-out on itemized deductions does still apply to the California return. If your income exceeds the amount shown here for your filing status, then your deduction will phase out at a rate of 6%, but at a minimum you will always be allowed to claim 20% of your itemized deductions. So your deductions are limited to the lesser of 6% of the amount by which your income exceeds the threshold amount for your filing status, or 80% of your itemized deductions. Form 540, line 18, California itemized deductions, or the standard deduction. You are allowed to claim the larger of your California itemized deductions or your standard deduction. And for 2011, the standard deduction amounts for California have gone up. And we've got $37.69 for single and married filing separate, $75.38 for married filing joint, head of household, qualifying widow, and for dependents, the maximum deduction is $950. Form 540, line 31, tax. For 2010, the tax rate increased by 0.25%. That was a temporary rate increase, and it is again dropped by that same amount for 2011. The 2011 maximum tax rate for individuals is set at 9.3%. If you have income in excess of $1 million, you are subject to an additional 1% mental health services tax rate surcharge, and the alternative minimum tax rate for individuals is 7%. Other tax rates that may apply to businesses are as follows. Non-California partnerships are subject to withholding requirements on the sale of California real property at a rate of 3.33% of the sales price, or up to 9.3% of the gain. The alternative withholding rate on the sale of California real property by S corporations is 10.8% and 12.8% for financial S corporations. And next on to special credits, and I would say one of the bigger things that happened for California for 2011 is taking that refundable child and dependent care credit and turning it into a non-refundable credit. All in all, the rules for both credits have not changed. How you go through and calculate the credit and the form that you fill out is similar to what you've had it in the past, but again, it is no longer a refundable credit. Also, California on its website has a list of the most common, or the 10 most common errors that it finds on California tax returns, and one of the items listed prominently is errors in figuring or reporting the California child and dependent care credit. So I'm not going to go through all of the rules with you in detail, but I will highlight what those main rules are, and it doesn't hurt before the first day of tax season to really go through and read these and be familiar with them, since it is a high error point on a California return. So these are qualifications to claim the California Child and Dependent Care Credit. Number one, married taxpayers or registered domestic partners must file a joint return to claim the credit unless you can show you lived apart at all times during the last 6 months of the year, you maintained a home for more than half of the year, and provided more than one-half the cost of keeping up a home for the year. In other words, if you're filing separately and you meet the test for being head of household, then you're going to be eligible to claim the credit, but otherwise you would not be. Number two, the care must be provided in California for one or more qualifying persons, and it goes on to define what a qualifying person is. Number three, the qualifying child care expenses must be paid by the taxpayer so that the taxpayer and spouse or RDP could work full-time or part-time, attend school full-time, or seek employment. So if the reason you're paying for child care is to go out to the movies for the evening, that's not going to qualify you. Child and dependent care credit is to entitle you or enable you to go to work and not to enjoy time off from caring for your own children. Next up we have, or rule number four, the taxpayer and spouse or RDP must have earned income, be a full-time student, or be disabled during the year. Rule number five, the taxpayer and the qualifying persons must live in the same home for more than half the year. Rule number six, the care provider cannot be the taxpayer's spouse or RDP, parent of the qualifying child, or a person for whom the taxpayer can claim a dependency exemption. Number seven, all required information about the care provider and the qualifying persons must be provided on California Form 3506. Incomplete information may cause delays or disallowance of the credit, and the information that must be listed on the form includes the physical address, street address, city, state, and zip code where the care was provided must be entered, and P.O. box addresses are not acceptable. Also, the taxpayer's federal adjusted gross income must be $100,000 or less. Ways to help prevent reduction or disallowance of the credit. The Franchise Tax Board routinely audits CDC credit claims to verify the information provided on Form 3506 and the taxpayer's entitlement to the CDC credit. During this audit, the taxpayer may be asked to produce evidence to support entitlement to the credit. An FTB may also contact the care provider to verify the information provided. The following tips can help prevent a reduction or disallowance of the taxpayer's CDC credit. The Franchise Tax Board recommends that taxpayers maintain accurate records, which include identity records for the care provider. For example, copies of driver's license and Social Security card, identity records for the qualifying person. That is, examples include copies of birth certificates and Social Security card, and proof of payment for the care expenses. Example, copies of canceled checks and money orders. Taxpayers should retain their records for at least 7 years. So what this is saying is if you have a client who wants to claim the child independent care credit, they need to maintain proof that they actually paid a provider. The proof should include some form of copy of identification of the provider, and it should also provide or maintain copies of payment proof. So either a canceled check that you used to pay that provider or a money order used to pay that provider. And clearly you should have a receipt from that provider as well. They don't mention what to do in the case of cash payments here, but certainly if you're making cash payments to your care provider, you should get a receipt at the time of that payment and maintain that proof. Also ensure that the correct information provided for the care provider on Form 3506 is accurate and up to date. Next up, we have the new jobs credit. So we're moving off of the child independent care credit onto the new jobs credit. This particular credit is relatively new. There's space allowed for it on lines 41 and 42 of Form 540. And essentially, this is a credit that is targeted at smaller employers who employ 20 or fewer employees during the preceding year and who have had a net increase in the number of employees for the current year. And if that is the case with your client, then that client can be eligible for a credit. But there is an application process that the client has to go through, and the credit is limited over time. There is a cutoff of $400 million. So once the total outlay of credit remuneration to small business owners exceeds $400 million, no more credits will be allowed for this particular new hire credit. But that limit has not been reached. And as far as I could see when I looked at the December 31, 2011 calculations, there's only been about $100 million of the $400 million limit reached. And so this is certainly a good credit that continues to be available. These are the rules for applying for the credit and receiving the credit. And there is, of course, an application process that a new employer has to go through. But if you qualify for the credit, it can be quite generous. Moving on, Form 540, lines 43 to 45, beginning with the credit for joint custody head of household and the credit for dependent parent. That credit has increased from $390 to $401. The maximum amount of the credit is $401 or 30% of the net tax. The credit for senior head of household, that credit is 2% of the California tax income, but the maximum California AGI you can have and still receive the credit is $65,153. And of course, the credit is limited to a maximum amount of $1,225, which is an increase over what we had in place for 2010. The credit for child adoption costs, California does have a child adoption credit, but of course you have to adopt a child who is both a citizen or legal resident of the United States and in the custody of a California agency or a California political subdivision. The allowable credit is limited to $2,500 for 2011, and a carry forward to future years is allowed. California also has a relatively new credit called the California Film and Television Credit. This credit has already reached its limit, and people who wanted to claim the credit had to do an applications process for it. Information about the credit is available on the California Film Commission website, and I've copied some of the information from that website into the manual. So if you happen to have a client who says that they made a contribution to the California Film and Television that qualifies them for the credit, this would be where you go to learn more. But it's a pretty specific targeted group of individuals who would be going for that credit and not what you typically see in your regular tax service offices. Form 540, line 46, non-refundable renter's credit. If you are a resident of California and paid rent on property in California, you may be entitled to this credit, and these are the threshold amounts for claiming that credit in 2011. The alternative minimum tax is another tax that California imposes, and you may owe California AMT if your income exceeds the amount shown here for your filing status. And if you are subjected to California AMT, you complete Schedule P to determine the amount of California alternative minimum tax that you owe. California also has rules regarding estimated tax payments, and California's due dates and amounts of California estimated tax payments differ significantly from the IRS. Remember, with the IRS, your estimated tax payments are due 25% on April 15th, 25% on June 15, 25% on September 15, and 25% on January 15. That's the federal system. California says, no, we're going to be different. They want 30% on that April 15 deadline, 40% on the June 15 deadline. No installment is due at all for the third quarter, and the fourth quarter that is due on January 15th through final 30% is required to be paid. If you have a liability on your California return of less than $500, you do not need to make estimated tax payments, and of course, on the federal return, that difference is $1,000. California real estate and other withholding. California does have a rule that demands backup withholding on the sale of real estate. The only exception to that is property that sells for under $100,000 in a foreclosure. And these are the withholding rates for 2011. There is a new 9.3% rate for individuals and non-California partnerships, 8.84% for corporations, 10.84% for banks, a new 10.8% for S corporations, and a new 12.8% for financial S corporations. Essentially, you go with these minimum rates, or you do a rate on the entire sale of the property. So you can do it on the gain using one of these rates, or you can do it on the sales price of the property. And if you want to or need to file the California report on that, these are the forms that are used to file the California report for that withholding. And there is a new rule that the non-resident report is no longer accepted via fax, that it either has to be mailed in or filed online. And the processing time, if you file it online, is 10 business days, and if you send it in the mail, it's up to 21 business days. Withholding information notice. Beginning August 29, 2011, FTB will issue you a notice when you submit Form 592 or 592F or Form 593, and there is a mistake, an underpayment or an overpayment, and the notice will include a description of any errors or balances. Contributions, these are the new charities. When you have your California return, you can donate to a California charity. You are able to donate whether you have a refund or whether you owe California, and these are the 3 new charities that are added for 2011. They include the Child Victims of Human Trafficking Fund, the Municipal Shelter Spay-Neuter Fund, and the ALS Lou Gehrig's Disease Research Fund. Also, another reminder here that California has mandatory e-pay for individuals who have a liability on their California return that is greater than $80,000 or who made a single estimated tax or extension payment that exceeded $20,000. And there are penalties for failure to use e-pay when you are required to. In earlier years, California did not assess the penalty, but California has now begun to assess the penalty, and the penalty is 1% of the amount that was not paid through e-pay. Interest and penalty amounts. The first half of 2011, the interest rate was 4%. For the second half of 2011, it is 3%. And now that we're into 2012, that interest rate is also 3%. Late filing of your tax return. If you do not file your tax return by October 15, 2012, you will incur a late filing penalty plus interest. The amount of that penalty is 25% of the tax not paid if the return is filed after October 15th. The minimum penalty for filing a tax return that is more than 60 days late is $135 or 100% of the balance due, whichever is less. So if you file more than 60 days after October 15, 2012, the penalty is pretty hefty. Late payment of tax. If you fail to pay your total tax by April 17, 2012, you will incur a late payment penalty plus interest, and the penalty is 5% of the tax not paid when due, plus 1/2 of 1% for each month or part of months the tax remains unpaid. And we're moving on down to line 115 of the Form 540, where you report your refund and how you want to receive it. California does allow refund splitting into 2 bank accounts, but if you split the refund into 2 bank accounts, all of the refund must be deposited and no amount can be received as a check. And additional topics of interest with regards to the California tax return. If you have a client who wishes to request an installment agreement program with California, California does have an installment agreement program in place, but there are fees associated with that program. The old fee was $20 for setting up the plan. Now it is increased to $34. And there are other payment services that had fee increases or fee changes. 2 of these have dropped and 2 of them have gone up. California has a really great tax practitioner hotline procedure. They have a tax practitioner hotline, which I have used over the years, and I find it to be a very good service. And back in April of 2011, FTB imposed a policy that said the number of cases that an agent could handle for a particular caller was going to be limited to 1. So if you were a tax practitioner and you called up the tax practitioner hotline with a question, you could essentially ask only 1 question or about 1 particular case. And there were enough complaints that came in from tax practitioners that the hotline now takes up to 3 cases for a call. So if you've got 2 or 3 things going on with various clients, you can call and take care of those all with 1 phone call. But if you have more than 3, then you would need to make 2 phone calls. And in 2010, California made a ruling about relying upon written advice and that there was relief from penalties if you relied upon written advice received from someone at the Franchise Tax Board. So this is not new, but I've just left it in here if you want to read that. California has an e-services feature on its website called My FTB Account, and this electronic services allows filers and their authorized representatives to view information about a filer's tax account, including the tax year payment activity, the total balance due on the account, up to 25 estimated payments, tax year summaries with payments applied, California wage and withholding information, Franchise Tax Board issued Forms 1099 and 1099 INT. And you can visit this link right here for more information. The site also allows for web pay. And for the My FTB account for individuals, there is a new feature that allows you to view an account summary and tax year detail for all tax years FTB has on file. You can also update your mailing address and your phone number, but note tax professionals cannot update their clients' information. You can also verify estimated tax payments before filing your return, review recent payments applied to your account, and look up your California wage and withholding information. So let's move on down to the new features with WebPay. Beginning in January 2012, taxpayers will be able to view and cancel their scheduled WebPay requests online. They will also be able to save their bank and contact information for future payments. New features for the FTB account. Expanded access. More taxpayers will be eligible to view their account information, and there will also be a mandatory e-pay indicator. On to individual e-file or modernized e-file. California has now entered phase 3 of its implementation of MEF, M-E-F. And what that means is that California is going to be retiring its old legacy system of e-file after October 15, 2012. And beginning in 2013, it will only allow for modernized e-file. Essentially, most individual forms and schedules, as well as many or most of the business forms and schedules, can now go out electronically. And the beauty of the electronic filing system under MEF is that modernized e-file continues after the filing season ends, so you will no longer have a situation where after October 15th you can't electronically file California returns anymore. You're going to be able to continue filing California back year returns into the future, in future years. Also, it will allow you to go back and file back your returns if the software you're using and the forms being filed were accepted through California MEF in the particular year that your software applies to. California, like the federal, has a mandatory e-file provision. California has had mandatory e-file for longer than the IRS has. And then we've got just this little note here, year-round filing and previous year filing for individuals. The Franchise Tax Board allows year-round individual e-filing and no longer will shut down the program after October 15th. And FTB also supports e-filing of certain previous year returns through individual e-file. Check with your e-file software provider to see if they support these individual e-file features. So what this means is, depending on the software package you're using, you may or may not be able to file California back year returns electronically. CPE requirements. CTEC is now requiring certain paid preparers who prepare Form 1040 series returns to obtain 15 hours of continuing education each year. The new rule does not apply if the preparer is an attorney, CPA, or enrolled agent, or an exempted employee of an attorney, CPA, or EA who does not sign the return. The IRS is now requiring tax preparers to complete the following education annually: 10 hours of federal tax law, 3 hours of updates to federal tax law, and 2 hours of ethics. CTEC has conformed its federal continuing education rules to match the IRS rules. And what that means is that instead of requiring 12 hours federal, 4 hours state, 2 hours ethics, plus 2 hours of federal and or state, that California now simply says, or CTEC simply says, you need 15 hours of federal and 5 hours of state. And what this means is that if you meet the federal requirement for federal hours, you will have met the 15-hour requirement at the federal. And of course, the federal is demanding 10 hours of federal law, 3 hours of updates, and 2 hours of ethics. So California no longer feels it's necessary to specify ethics because the federal is already specifying ethics. So California is just trying to keep it simple by saying 15 hours federal and 5 hours state. But don't believe that just because you got 15 hours of federal that the 15 hours will be accepted by California, because remember, both California and the federal have separate registration processes. So in order for federal hours to qualify for the IRS, they have to be from an IRS approved provider. And for those 15 hours to qualify for California, they have to be from a CTEC provider or a CTEC approved provider. So naturally, if you choose a provider who is approved by both agencies, that is both CTEC and the IRS, then the same continuing education hour would qualify at both federal and CTEC levels. So as a reminder, CTEC and the IRS are independent agencies, and each has different rules and deadlines for tax preparers. The following rules apply to California registered tax return preparers. As a CRTP, you must comply with both CTEC and IRS rules. You must maintain your $5,000 California bond. Your CRTP renewal application and the $25 annual renewal fee are due before October 31 of each year. There is a $15 penalty or late fee if you submit it after October 31st. Now, effective of November 1, 2012, the annual renewal late fee will increase from $15 to $55. And also, due to high numbers of late renewals, CTEC is enforcing the following renewal policy. Effective January 15, 2013, CTEC will shorten its grace period for late renewals from 12 months to 10 weeks. CRTPs who fail to renew their registration by January 15th of each year will be required to retake the 60-hour qualifying education course, pass a competency exam from an approved education provider, and register as a new CTRP. If your registration has lapsed for more than 1 year, you are considered to be a new tax preparer. 2012 Enforcement Team, this is referring to CTEC's enforcement team. The Franchise Tax Board Enforcement Team will visit tax preparation offices during the 2012 season to make sure unregistered tax preparers get into compliance with the law. And if they catch you operating illegally, you will be issued a $2,500 penalty letter from Franchise Tax Board. At that point, you have 90 days to comply before the penalty is enforced. And if they don't comply after the $2,500 penalty is enforced and continue to file tax returns illegally, the penalty increases to $5,000. The enforcement penalty is assessed upon unregistered tax preparers who prepare and sign tax returns. The penalty may also apply to anyone who assists with preparing the tax return. The only exception to the rule is employees of attorneys, CPAs, and enrolled agents, but only if the employee does not sign the return. If the employee does sign the return, then he or she must register with CTEC. And on the very last page, I have information from the California Board of Accountancy website on the current rules affecting CPAs and their CPE requirements. So that concludes my update or review on California tax law for the 2012 filing season. And the final password of the class is Lassen, L-A-S-S-E-N. So at this point, we are now finished with our 2011 California update, and you can return to the LMS to take your password test. If you are a self-paced online student, you will also need to take the California Update quiz. Once you've successfully completed both those tests, you will be able to print your certificate of completion. Thank you for attending today's update class. We look forward to seeing you at more of our education programs in the future. Bye-bye.